Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. We know that the stock market is going through a major turmoil right now, with many companies down over 50 to 60% from their all-time highs last year. But over the last 20 years, tech companies have done incredibly well. Look at the stock performance for companies like Apple, Amazon, Microsoft. One company that has done well over the last 20 years, but it's not considered in quite the same league as the other tech companies, is Oracle, led by the billionaire Larry Ellison. As the trend of cloud computing dominates the tech world and businesses scramble to move to the cloud faster and with more intensity, will this bring a change in Oracle's luck? Recently, Oracle and Microsoft announced a partnership to make Oracle databases available on Azure platform. In this video, let's have a look at whether Oracle is a value play or a value trap at these levels. Before we start, please smash that like button so others can find this video as well, and do subscribe to get more updates on such companies. What is Oracle and who started it? Oracle is an American tech company headquartered in Austin, Texas. It is one of the largest software companies in the world, with revenue over $40 billion and market cap over $200 billion. The company primarily sells database software and technology, cloud engineered systems, and enterprise software products such as enterprise resource planning software, human capital management software, customer relationship management software, etc. Here is the breakdown of Oracle's revenue streams. There are four main revenue streams. Cloud services and license support contributes over 65%, cloud and on-prem licenses is around 20%, hardware and services are around 7% each. These line items, especially on cloud, hide more than they tell, as Oracle does not break down the different segments of infrastructure as a service, platform as a service, or software as a service. We'll come to that in a bit. For now, let's stick with the introduction. Oracle was founded by Larry Ellison in 1977 under the name Software Development Laboratories. It changed its name to Relational Software in 1979, then again to Oracle Systems Corporation in 1983. Finally, in 1995, the name was changed to Oracle Corporation. Larry Ellison is the co-founder, executive chairman, chief technology officer, and former chief executive officer of Oracle. As of September 2022, he was the 9th wealthiest person in the world with an estimated fortune of around $93 billion. The bull case for Oracle. Let's start by looking at the bull case for Oracle. There are two factors here: fundamentals and shareholder-friendly management. Let's look at both. Fundamentals. Oracle suffered from a significant stagnation over the last decade. The company had its legacy software services and it struggled to find new paths for growth. Going with the trend, Oracle decided to focus on its cloud offerings somewhere around 2016. Too late, but nevertheless, that pivot helped Oracle to start growing again, with 5% revenue growth rates till 2020 and touching 10 to 15% in the recent years. Analyst consensus is for around 10% revenue growth in the medium term. Oracle CEO Safra Catz in the last earnings call said that cloud service and license support will also see growth acceleration and could well see double-digit organic growth. As I said earlier, our fundamental principle is to grow earnings per share while accelerating cloud revenue growth. Given our increasing confidence in organic revenue growth, we will continue to prudently invest back in the business, and you can already see the returns in our performance. Number 2, shareholder friendly. Oracle is incredibly shareholder friendly. This can be seen through its sizable dividend increases and share buyback programs in the recent years. The company is a stellar free cash flow generator, defined as a net operating cash flows less capital expenses. Its annual free cash flow averaged around $10 billion in the last 2 years. Oracle's dividend payout speaks to its confidence in the free cash flow generating prowess of its business. Its run rate dividend obligations stood at around $3.5 billion in 2022. The current dividend is safe and the dividend cut is unlikely. The current payout ratio is just around 52% of GAAP earnings and around 24% using non-GAAP earnings. The company has increased the dividend 9 years in a row and has never reduced it since it initiated it 13 years ago. The current yield is low at 1.6%, but there's much room to grow despite the fact that dividend has almost tripled in the last 10 years. But not everything is fine with Oracle. Let's have a look at the bear case. The bear case for Oracle. Number 1, competition and cloud market share. Oracle is significantly lagging behind its competitors. The company's share of the cloud infrastructure services market in 2022 is just 2%. Also, it's a distant second in various SaaS markets such as customer relationship management software, in which Salesforce leads. One of the reasons Oracle has lagged behind the competition is that it's been very slow to transition to the cloud. A full-fledged Oracle cloud infrastructure was launched only in 2016, while competitors did it much earlier. Customers are reluctant to use the Oracle cloud infrastructure due to the quality of the ecosystem, its complexity, and poor customer experience. Oracle's cloud infrastructure is considered as second tier, remains more like bare bones, minimal viable product that does not address the broad ranges of common cloud use cases. Number 2, mergers and acquisitions and debt. Oracle's debt is significantly higher than its competitors. The company carries around $80 billion in debt. If you compare that to Microsoft has around the same debt but roughly 10 times Oracle's market cap. A more meaningful comparison would perhaps be with Salesforce, which has slightly lower market cap and has around $14 billion in debt, which is roughly 1/5 of Oracle. While Oracle has high debt, at the same time, the debt repayment does not seem to be a priority for the company right now. This is because Oracle is funding its buyback and heavily investing in mergers and acquisitions, the latest one being Cerner, a US-based healthcare IT software and hardware provider, which Oracle bought for around $28 billion. Although leverage is not usually an issue in the software industry, as companies have high margins and strong cash flows, but carrying too much debt poses many risks. But raising debt for buybacks and M&A, particularly when M&A is focused on expanding to certain markets rather than improving the cloud infrastructure, seems somewhat risky. Valuation. Oracle's current market cap is around $200 billion. Looking at Morningstar, its current PE ratio stands at around 31, while its 5-year average PE is around 26.5. Its earnings are expected to grow at around 10 to 12%, so this looks somewhat overvalued. From a cash flow perspective, it's trading at around 22 times operating cash flow, which is about 40% higher than its 5-year average of 15. So overall, it seems somewhat overvalued at the current prices. Most Wall Street analysts rate it as a hold at these prices. Verdict. Oracle is not the first name that comes to mind when you think of big tech. However, this giant company consistently grows and delivers improved results to its shareholders. Oracle offers a wide range of cloud services, particularly in the SaaS space, so you cannot count it out yet, even though the competition in all cloud markets is fierce. At around $200 billion, it looks like Oracle is fairly valued for now. That's it from us. Hope you enjoyed this update. Please smash the like button and be sure to subscribe to get the next videos. Thanks for watching.